I've been Reppond. Welcome to my YouTube broadcast on market insights. Today is January 25th, 2023. I'm going to begin with the dashboards. I'm going to present just a lot of information on the direction of the market, the strength of the market or lack of strength, and from different points of view. So I start with this, which is a dashboard. This shows four major U.S. indexes, two foreign indexes, and the long-term government bond. The four U.S. indexes are the Dow, the S&P, the NASDAQ 100, and the Russell 2000 Small Cap Index. And those are represented by SPY, DIA, QQQ, and IWM. To the right of those indexes, and this shows how they did last week and how they have done year to date. So you've seen, contrast to last year, they have done very well. The S&P 500 is next to last, and that's kind of the benchmark. It's up 3.52% for the year and was down last week by about 0.25%. If there is a green dot, it shows that they are above their, going from left to right, 20, 50, 100, and 200-day moving averages. If it's a red dot, it's below those averages. So the strongest indexes would be above, and the weakest, a weakness would show a red dot, which is below. When we break the S&P 500 down into its 11 sectors, industry sectors, these are the 11 sectors. On the left column are the ETF, Exchange Traded Fund, and then the description of that fund and how they did last week and how they have done year to date. So last week you can see that 3 of them were positive, all the rest were negative. Last week was a mixed week. It was all down except Friday, which was up nicely. And then to the right, the next column shows how they are year to date. They go from a high of 7% for the retail sector all the way down to negative 1% and negative 2% for the healthcare and consumer staples. What's interesting is when you contrast this with last year, a lot of the ones that are on top were on the bottom last year, and vice versa. Those on the bottom were on top last year. I think they all lost money, but the ones on the bottom that are on the bottom this year lost the least money last year. Okay, this is a chart of the S&P 500. It's a weekly chart showing one move equals 1 week, and over the past year. So the 20-period moving average moves through that data, and you can see we're at the very far right of the chart. We are above the 20-period moving average, but last week for the S&P 500, which you saw in the previous chart, was slightly down. When I compare the growth stocks in the S&P 500 to the value stocks, the growth stocks are on the short term higher. You see that at the very end of the chart, it ticks up and growth went up a little bit. That's short term. Long term, when you look, this is a 14-month chart. When you look at the 14 months, you can see, generally speaking, value stocks are in favor over growth. If it went up, that would favor growth. If it goes down, that favors value. And this is the magnitude of the difference between growth and value. For the last 24 months, this is the chart of the small cap index, the Russell 2000, represented by IWM compared to SPY. IWM numerator, SPY denominator. SPY is the S&P 500, and it's the ETF representing that index. And I put a line at the end for the last year, and you can see that has stabilized. Prior to that, small cap was out of favor, which meant it was dropping. It was worse. It fell further down than the S&P 500. Now, it looks like small cap is doing better slightly than the S&P 500, but generally it's kind of similar. It's not moving up or down much more than the S&P. For the last 31 months, this is the long-term government bond, TLT. It's not a relative chart, it's an absolute chart. And it's a weekly chart showing one move equals 1 week. And you can see the direction of the long-term government bond. This is the bond price, not the bond yield. So and it's the long-term bond. So you can see there were 2 periods of time, one represented by the first arrow on the left, showing the downward direction of the long-term government bond. The second is the second arrow on the right. It shows that, again, it's been down. Recently, it has shown some strength, which you can see at the bottom, and is now slightly above the 20-period moving average. But the general direction is still down. The dollar, the US dollar, there's the ETF UUP, and you can see that for, it's a 20-month chart, you can see for about 16 months that it moved in an upward direction, showing a strong dollar. And now in the last several months, you can see on the right side, the dollar is declining. And this is relative to, generally is relative to other currencies. But it means that foreign countries or foreign currency, when our dollar is cheaper, that we're more favorable to attract that currency and to invest in the U.S. And when it's higher, it's more expensive to invest in the U.S. When you flip it around, when we spend money elsewhere, if our dollar is cheaper and theirs is more expensive comparatively, then it's more expensive for us to invest or to expend money abroad, and vice versa. If our currency is strong, then it's less expensive for us to spend money abroad. Gold, represented by the ETF GLD. This is a 12-month chart, and you can see that for a period of time, gold was declining. And then at the right side of the chart, gold is going up. Now, I will be the first to tell you that I believe gold and silver and precious metals are manipulated. What is not manipulated is the premium that you pay on top of that when you buy gold or silver in physical form. There is a markup, there's a retail, and they are in high demand, and you can tell that because the markup reflects it. But the spot price, the designated price, is probably manipulated. I don't know if anyone can figure that out. There's some theories on it and speculation, but I'm not sure there's a really solid answer. It just doesn't seem to track necessarily with supply and demand. But gold is up. When we look at silver, it is up, but it is not as pronounced as gold is. So you can see it generally goes up, but it's kind of fading off at the end and relative to gold, which is surging up. So they trade places back and forth. And I can't explain why that phenomenon is, but then when I take and put them on a relative strength chart, silver being the numerator, gold being denominator. If it goes up, that favors gold. If it goes down, that means silver is going down relative to gold. So in this chart, you can see they're both, generally speaking, silver outperformed gold over this period of time since September. However, recently, in the last couple of months, silver has come down, or is going up, but it's not going up as fast as gold is. Bitcoin. Now, you know that I am not a fan of Bitcoin, and I prefer precious metals. I don't think there's intrinsic value in Bitcoin. You may disagree, but we can agree to disagree. But it still is in a downward direction. However, at the end of the chart, since about the beginning of the year, Bitcoin has been surging actually, and is up as of today probably It's hard to imagine this on this chart. Okay, Bitcoin's dropped about 70%. This little tick up, because if it goes up 70%, it doesn't go back to where it was. You've got to go up a lot more than 70 to recover that 70. But that little surge up, as of today, since the first of the year, it's up about 30%. Just that little piece. So if I were to just magnify that and look at what happened maybe on a daily basis since the beginning of the year, you'd go, wow, that is a lot. But because it has dropped so far, it doesn't look as pronounced. So that's what Bitcoin's doing. That's a 14-month chart. Okay, now I want to show you the volatility index. Now the volatility index is it's an index. It moves throughout the day, and it reflects the degree of volatility in the market, meaning that if it goes up, there is increased volatility, which usually means the market is going down, and vice versa. So you can see that in general, for the last several months, that the market has had more strength in it and has generally gone up, and the volatility index generally has gone down. But the last week was more often than not a negative week for the market, and so you see an increase in the volatility index. And I put a black mark to show the arbitrary level at 24, which is, if it's below that, it's favorable, generally speaking, and if it's above that, then that's generally considered negative. Asbury Research, now, even though the market was slightly negative last week, the Asbury Research, there are 6 metrics called the Asbury 6, was positive by the end of the week. So all 6 of them were in green territory, and that's positive for the market. And this is the cross-asset relative performance chart showing the 3 columns to the right, the view of the last week, the view of the last month, and the view of the last quarter. And if it's a green box, that shows that there is more strength in that particular asset for what is compared to. The first one is I'm just going to focus on all the ones that are all green boxes. The high beta stocks, high volatility stocks, are more in favor than low beta, low volatility. The broad market is stronger than the blue chips, meaning the Dow. And through most of last year, it was a reverse of that. Technology is in favor over the NASDAQ or over the S&P 500, and again, we've seen that just from some recent strength. Developed countries are stronger than the U.S., and emerging countries are stronger than the U.S. Corporate bonds are performing better than government bonds, and corporate bonds are performing better than high yield bonds. So, U.S. versus the world. So we've been looking at this for a long time. The U.S. is nowhere on this chart from a green box perspective. Is it strong enough to be anywhere on the chart that is stronger than another country or another region? And when you list all of the countries that are on here and the regions that are on here, emerging countries, Pacific, the Eurozone, which is more developed countries, and all of the individual countries, they're all stronger in the green boxes than the U.S. Even some you wouldn't expect. I take the developed countries with the exchange traded fund, EFA, and contrast that with SPY, the S&P 500, U.S. So you got the U.S. and developed countries, generally speaking. Most of the developed countries are Europe, but it should include probably Canada, Japan, South Korea, and Australia, all developed countries. You can see in the last 3 months or so the direction of that's down. That means the U.S. is that far out of favor relative to the developed countries. If this is going up, it favors the U.S. If it's going down, it favors the developed countries. It's a big magnitude, and of course that's reflected in the previous data that I showed you. Gold and silver. Well, you've seen the gold and silver charts, so here's some data. The spot price of gold is $19.29. For buying gold bullion, you add roughly $100 to that. So a little over $2,000 an ounce for an ounce of gold bullion. Not non-silver eagle, I'll say it that way. Or excuse me, non-gold eagle. And silver is $23.98. Gold went up a little bit this past week. Silver went down a little bit. And but both, as I showed you on the previous chart, over the last few months have shown strength. The bull says, I'm social distancing from reality. The bear is kind of taking it all in. Maybe that's where we are today. Thank you for watching. If you have any questions or comments, leave them in the comment section below and I'll try to answer your questions. Thank you for watching.